Hey guys, we're back with the Holy Macro Show, and we're live with Kashop today. We have a bunch of cool stuff to talk about. We haven't been on for a minute together, and the markets continue to move. There's all types of things happening. So what's been up, Kashop? What's got your attention? What is going on in your opinion? Because it's been a very different market this year.
Yeah, so I think it's been a couple of weeks since we did this, and in that time, I'm used to hearing this news like every day there's an alert on my phone from Yahoo Finance saying market hit a new all-time high, new all-time high, new all-time high. It's gotten to the point that I don't even care. It's like, tell me when it's not hitting an all-time high, because I think that would be news at this point. And we saw some crazy swings with Palantir making the news most recently, and then Supermicro Computer, that's in the tech space. In the commodity space, it's like almost no one's talking about it, but copper is going straight up, gold is going straight up, oil's kind of torn between the Chinese tariffs and the bullish commodity news. So I don't know what's happening there, but to make up for oil's underperformance, natural gas is going straight up. And I don't think we have seen natural gas above $4, except for that brief spike in 2022. I don't think we have seen a real bull market in natural gas in a really, really long time now. I don't know how many years it's been. Maybe you can provide that fact, but I think that's going to surprise a lot of people to see gas moving like that, because everyone talks about what oil does to inflation, but especially in the US, the impact of natural gas is actually much more, if you ask me, because everyone's kind of used to how oil works its way in the economy, and with natural gas it's going to be a surprise. So, and of course, coffee is hitting all-time highs, cocoa does this thing, lumber does this thing. All of this just shows very clearly that inflation is back. And the weird thing is that financials are doing great even as inflation is back. Utilities are doing great even as inflation is back. If you go back to 2018 and you told me utilities and financials would be in a bull market, but we would have CPI going up, the official CPI is 3%, maybe actual inflation is closer to 10%. And with all of the commodities moving up, if you tell me that utilities and banks are fine, I would have been very surprised. So it's not just the resilience of the indices, the S&P, the Dow, the Nasdaq, that's surprising. It's also we are seeing so many correlations break, correlations that you would have taken for granted, not as a statistician, but as a macro trader. Correlations that you thought would hold forever are no longer holding. So when you say this market feels very, very different from how other years started, I completely agree with you. I think every week there is a new surprise. And it's not just the market hitting all time highs. Yeah, I mean, that's something everyone focuses on. I'm not talking about that. I'm talking about the way bonds are moving, the way the yen is moving, commodities are moving, utilities, financials, all these sectors are moving. And the dollar kind of hasn't tanked yet, but you can already see Latin America moving. You can already see China moving. So it definitely feels like we have a rotation out of the Max 7, even as the Max 7 keeps going higher. So I don't know where the money is coming up for this major bull market and everything. I really don't know, but it doesn't look like it is going to stop. Now, does that mean there won't be rotation out of tech, which will, hit the indices? I think there will be. So that's kind of something that I am preparing for. That's been the focus of a couple of my articles, which I wrote in December and January, saying prepare for the Minsky moment and how the tariffs remind me of the roaring 20s and all the parallels. But overall, it just looks like we have a strong bull market. And here's the thing. So you can have a strong bull market at the same time the S&P 500 can have a period of zero returns. And we saw that in the 2000s. The Nasdaq composite went nowhere for 15 years, but if you asked anybody from 2002 to 2006 whether there was a bull market or not, yes, of course there was a bull market. So maybe we are setting up for one of those periods in history where the relationships are just completely turned upside down. I don't know, but that's the long answer to your question.
No, that's great. I'm messing with this chart. It might take like a long time to figure out how to get the dates perfect. Just scrolling through and type it in, but I'm trying to figure this out all at the same time. But just looking at it, like you said, this is an interesting time to look at, and that's why I wanted to. You're talking about it. I wanted to bring this up because this is important. I keep covering this over and over again, and I don't think people are really understanding the point here because it's something that's much bigger than people are giving it credit for. So we're looking at this chart here, and what you just said is so important. So this is starting in 2001. We basically see all of the sectors in the S&P 500. These are the spider sectors. What do people see here? Where's technology? And like this is the thing that people continue to like kind of think like I'm crazy because like once again it's like I'm not sitting over here saying something like um, technology is dead forever or the S&P 500 is dead and it's going to crash. I am saying there's plenty of periods and times in history when the S&P and technology have massively underperformed and mainly driven by technology when technology gets too big. And this happens with new asset classes all the time, or the internet. At that time, it was going to change the world. Now AI is going to change the world. Everybody piles in all of those stocks, and then what happens to the S&P 500? The weighting of the S&P 500 is just fully into technology. And so, as we continue to be fully into these technology stocks, we start to see, okay, well, where do people go from there? Do they go to places like energy? Like that's what we saw in 2000. They went to gold. Gold was the massive outperformer, especially for those 3 years during the recession into 2003. Energy kind of chopped around. Some of these sectors chopped around, but gold continued to move higher. And then once we got to 2003, silver started to really catch up and be the outperformer. The commodities were the massive outperformer in the market. And so we're kind of seeing that today. And also, another thing that's the outperformer that a lot of people don't have any clue about, but we'll show you here today. You're not going to hear this anywhere else. But this is the Latin America ETF. Latin America ETF was massively outperformed everything. And so what is this really? And this looks like a weak dollar market. And just looking at the year-to-date returns and like, let's take it all the way back. Year-to-date, this looks like a market that's rotating into international stocks, looking at weaker dollar plays and so on. So, that's going to put some major pressure on the S&P 500, which has been so technology-based for so long.
I didn't even know there was a Latin American ETF that goes back to 2000s. That's surprising that it
Isn't
managed to
it?
stay. It's surprising it managed to stay listed.
Yes, it's interesting. So, is my voice fixed at all? Did it go back
Yeah,
up?
yeah,
Okay,
yeah.
cool. Yeah, I don't know why my mic keeps going in and out. Sorry about that, guys. But yeah, no, the ILF is super interesting because it's like it's an ETF that's been around forever, but if you've been trading in the last 15 years, it's been dead. So why would you hear about it? And now looking at it going forwards, it's like, no, this is actually an interesting place to be, especially when Latin America is outperforming and massively outperforming at the moment. The only thing that's, I think, outperforming it in the international market right now is Poland. So once again, we're looking at, that's the ILF, that's Latin America. So that's 13%. We look at China, that's 20% year to date. I mean, these are crazy moves that are happening at the beginning of the year, and who's talking about it? Once again, people always ask about silver. Okay, let's look at silver. I think it's got futures on. I don't ever look at futures on Koifin much. So yeah, here's futures. So we're looking at silver, 13%. So the XLE is up 7%, which is a good return. It's one of the top performing sectors at the moment, and in the United States. But then behind that is communications, healthcare. You know, like you said, it's odd because it's like, what's the false move here? Is energy the false move, or is healthcare the false move, or utilities and so on? I think this more of a reflationary cycle. If I was just to kind of look at it and go, okay, if we're seeing this type of performance in the international stocks, if we're seeing the financials continue to move higher, and we're seeing communications, which actually do well in reflationary environment, I think we're just in that style of an environment. The problem with this environment is that this is like before the end of a cycle. This is the environment that happens. Think of 2021. You get the melts up in the commodities. Yes, the S&P was fine, and so that's why I'm kind of saying, hey, I'm not bearish on the S&P by any means, but I also think like you're going to want to be in the outperformers. So what's the point of owning the S&P if it's in fully into technology, and technology is the most underperforming thing in the index at the moment? So I would continue to look at these other sectors and these other countries and the commodities for places to be to make money this year. And yes, it could change, it could shift, but for now, this is as clear as day. You can't say or argue with the fact that China is up 20%, and was the outperformer last year as well. And then you've got silver up 13%. You've got Latin America up 13%. Colombia is number two in the countries, and I think it's up about 20%, and then Poland's up 25%. It's not because I love Poland or Colombia or all these things. It's a weak dollar play. And so this weak dollar play is kind of showing up without the dollar being really weak just yet. And so if we look at the dollar index here, we can see that this is, that weak dollar play has really come in since the beginning of this year. The dollar topped out. You saw that China actually was under a little bit of pressure at the beginning of January. And then the second the dollar topped out, China started raging higher. And it's all one trade. That's the thing. A lot of people, we want to always dice things up. And I think that's part of our brains as just humans and traders. We want to dice it up, but this is all one trade. If the dollar continues to move down here, things like copper, gold, silver, China, these things are going to do very well. If the dollar starts to move up here, they're going to come under some major pressure. And I think it's as simple as that at the moment. And not to mention, if the dollar gets stronger, like everything's done. I don't think the dollar can start to get above 110 without putting major pressure on the United States market and the global markets. So I think it's within everybody's interest, including Donald Trump's interest, our president, including the Fed's interest, including global central bankers' interest, that the dollar gets a little bit weaker here. So I think this is the play going forward, and I think inflation is going to probably continue to move higher.
So I think it's the current administration hasn't come out and stated it as such, but if you go look at all of JD Vance's arguments, the whole Make in America thing, it depends on a weak dollar. You will not have manufacturers moving back to the US if the dollar is raging. So I think it's very much in the interest of the administration. If they want to bring manufacturing back, then they're going to have a weaker dollar. So what does this do? So the weaker dollar reliquefies the world. So we get inflation, we get booms in emerging markets, we get booms in both the commodity producing and the commodity consuming countries. And what happens after that? So what happens to the US market, which has attracted capital since probably 2008, 2009? So what happens to that market when the capital starts to flow outward? Because Trump talks about the trade deficit, but the trade deficit and the capital account surplus, they are just two sides of the same equation. You sum them up, it goes to zero. So why does the US run a trade deficit with the rest of the world? It's because you print dollars and you get goods in return. So now the dollars that you print go to China, go to India, go to Brazil, all these countries, and the goods come in to the US. So what happens to the dollars? So those dollars, they get recycled back into the US, feeds the bubble in equities and real estate, all sorts of investments that are made within the United States. So now, when you have a weaker dollar, when you have manufacturing coming back to the US, and you have tariffs which cut down the trade deficit, what happens to that capital account surplus? It dwindles. So you're going to see less flow of foreign money into the US market. And what does that do? That is definitely not good for stocks. Now, which sectors, how does it play out? That's the question that I don't think the market has answered that question yet. And once the market answers that question, I think the move should be very swift, because one thing we have seen in this cycle is all the moves that are happening very rapidly. So the kind of moves that would take 2 3 weeks earlier now happen in 2 3 days, and it's just because too many people are paying attention to the same bit of news, and everyone's kind of moving in sync right now. So uh, usually you have the trend followers and the mean reversion traders, and right now the trend has gotten so strong that the mean reversion is like a trend in itself. So something just overshoots, the mean reversion overshoots, and then it feels like we just have only trend traders right now. And I know you're a trend trader, but of course you're a much longer term horizon than what I'm talking about here. But do you get the same sense that mean reversion is dead?
So it's tough because it's like what is the time frame of mean reversion, and mean reversion is always going to work very well in equities. And once again, I find my edge is this. When you're looking at trend following in a long-term time frame, you have time to let those trends really run. If you're looking at it in a short-term time frame, there is always going to be reversion to the means. So, there's two different things to think about here. Is it dead in the sense that we're never going to see this choppiness in the market again? No, we'll see choppy periods in the market. Will it just keep raging higher forever? No, but we are in a bull market, and that's a thing that structurally is hard to say because fundamentally looks very different. So the S&P 500, if we just look at something as simple as the SPY, it's a bull market. And so, these downtrends that happen in the interim, they're going to happen, but most of the time we're going to wipe those out and move back to the upside. It's just the structure of it until psychology changes. And when the psychology changes from traders, then everything's going to change. And I think that's what happens at these periods where we really see a real top. Right now, everybody is still feeling mania about whether it's Donald Trump, whether it's globally, whether it's this, that, or the other thing, whatever they're feeling, there's mania, which is how trends happen. But so, this is still just year two of a bull market. And I still think there's time for this thing to move higher. Do we think this thing's going to just rage forever? No. I think the money's going to start flowing into these different areas going forward. And I think that's a thing that people really need to start paying attention to here right now is that money is flowing into these different areas. This could be the underperformer.
Yeah. But what do you see outside of the equity market, like in the commodities? Are you seeing mean reversion still as strong as it was before on the days to weeks time frame, or have you seen something change there as well?
Yeah. So uh, say that again in a clearer question.
So we have trends, and then we have mean reversion within trends. So right now it looks like, just eyeballing all the charts, it just looks like we don't get those mean reversions or those periods of chops, the horizontal channels, some of those typical patterns that you would see during an uptrend. It doesn't feel like we see that anymore. So do you concur with that, or are you seeing something different?
So that's a great question. So let's just zoom out. And this is why, for me, I'm a longer term trend trader, is because it's just stressful to be trading in and out of things like this all the time. When you have a move that's strong and things are good, I want to be in those strongest sectors that are outperforming and that have the least amount of chop, and then I can hang out in. So when we're looking at something like this, do we always see a lot of choppy periods in the market? The answer is no. We don't see a lot of chop. If you look at these periods here, like, yes, that's a period of chop. Here's a period of large pullback, obviously the great financial crisis. But most of the time, you're right, hanging out in these major trends until something fundamentally changes. Now, that's not saying something can't fundamentally change. I think we're starting to see the beginnings of it today with the year-to-date returns. What we're seeing this weak dollar play come in. We're seeing money flowing out of the United States into these other areas. As we're seeing that happen, we will probably start to see more chop in the S&P 500. And think about it like, not even like 2022. Great example. The energy stocks continued to just move up and to the right while the S&P 500 went straight down. Do I think we have something that detrimental coming up quickly? No, I don't. But I'm always ready for it. I think it's something good to be prepared for. But I think that's part of the reason why I'm always looking at where can I be outside of the S&P 500. I don't ever trade the S&P 500 itself, and the reason is the weighting of it is so large that I might as well just be in the Nasdaq if I'm going to be long the S&P 500. So I'm long the Nasdaq most of the time. Now it's getting to the point that why would you be long, buying Nasdaq? For example, we still have long positions in the Nasdaq, but that's the smallest part of our portfolio at the moment. Right now, those real trades that are coming up are the ones we've been talking about, which is energy. We're looking at the commodities. We're looking at all these other areas in international stocks that are trending. I'd rather be in those things that are going to trend nicely rather than the things that are just going to chop sideways. But I think for short-term mean reversion traders, do you want to you need to trade on such a short-term time frame to make it work well, that it becomes really crazy, and then also the risk to reward doesn't work out right in a short-term mean reversion system. So if we're looking at risk to reward and going, okay, here's a 1-to-1 risk to reward, meaning I'm making $1 or losing $1. That's where stuff gets really hard. So, you basically have to get every single trade right or you're losing money. And then one trade can blow up most of that account. So whereas if you're looking at these more longer term trends here and you're just really riding the trends, that's why, trend traders who, and I'm not saying like trend following itself isn't always the easiest thing to do. But if you're looking at it and trying to be in where relative strength is, where the outperforming sectors are, looking at international and so on, you can really make a lot of money and not have to deal with those drawdowns or dips. So Kashop, why don't you add to the dollar? I've got to check on my dogs because they are going nuts for zero reasons right now. So I'll be right back.
Sure. And that's the fire alarm going off here. Sorry about that, guys.
Oh, perfect timing.
No. It's like there's still construction going on, so someone smokes, it just sets off the alarm.
Oh, okay. Nice. Never mind. Somebody else got it, so we're good. I'm good. So, okay, but yes. So I'll go back to just the dollar a little bit more, and then because I want to talk about how the dollar will come into play in this scenario. So if we go back to, you know what? Let's bring the dollar chart back up. Let's go long term. Let's actually go to a quarterly chart of the dollar. And don't mind my little top hats on here. I did a presentation on this the other day. So basically, when we're looking at the dollar here, my main point in bringing this up is that, like, we've seen the dollar cycle many times. And this is just another period where it seems like the dollar is topping out. Normally, most of the time when we see a currency, bonds, whatever it is, this blow off top here, or blow off top here, or blow off top here, is usually when this thing starts to turn over. And I think this is what we're seeing today. We're in 2000s. I think the market looks very similar, and I think it's very good that you're bringing up 2000, because that is really the setup we kind of have here right now. We're in an inflationary environment where inflation continues to move higher. The market continues to say, hey, we're moving into more of a international based environment. Currencies were all at support last month, like literally all of them. Almost all of them were at support last month. Um, and then not to mention the commercial buying in these currencies. So basically, we had lopsided positioning in currencies against the dollar, meaning the dollar usually goes down. And so then the dollar basically topped out right around that point and reversed lower. And then money started flowing into these other areas. Now, there's plenty of times lately where the dollar starts to move down and money doesn't flow into international stocks. Now money is flowing into international stocks. And once again, I can't say like, hey, and I think this is the important thing to understand as a trader. I can't say this is going to continue for one full year. I can say that I want to be in these positions because I have buy signals right now, and this looks good. And I think that's all you need to do as a trader. I think too many people want to make a prediction on it. And this is the thing that I'm seeing lately with the international stocks. People are making predictions that this is going to last forever. And it's like, it's the same as being a perma bull on the United States. Like, we don't know what exactly will last forever. As a trader, we have to trade it. But does the cycle look right that this could last a lot longer than people are thinking? I think so. But you want to trade it like just any other trade. Be willing to get in and out of it. But it looks like the weak dollar cycle is coming and the commodities are going to follow higher with it. And I think that's when things start to put major pressure on the United States markets. And if we get that inflation and we get oil popping, back to over 100 and so on, it would put a lot of pressure on the United States markets. And that would probably be the catalyst to possibly make the market, the S&P 500, start to actually be in a big drawdown.
Yeah, I think that's kind of what I was expecting when I wrote my article preparing for a Minsky moment. It's on my website and Twitter. I think the kind of speculation, the bullish sentiment has gotten close to an extreme now. When you say something has been close to an extreme, it likely means it's going to go surprise you. Like, I remember looking at the chart of Palantir and thinking, no way this is going higher sometime back in last September or October, and then it's just straight up since then. And it just happens. But when those moves correct, it's going to correct pretty violently. And that's something that I don't think anyone is prepared for. So for me, my positioning is very simple. I have commodities across the board. So majorly bullish on gold miners. And that's, of course, as everyone knows, that's my specialty. Majorly bullish on the gold explorers because the projects that were uneconomic at $2,000 gold are now highly economic at $2,900 gold. And Goldman Sachs says gold is going to $3,100 this year. Probably it's going a lot higher. I don't know. But what happens is when you see these moves happen in the gold price, when you see the NPV of these mining projects pick up, and especially now with Trump in power, talking about how he's going to fast track permitting for any company that's going to invest over $1 billion. And Canada has kind of come to the realization that even they need to develop their own resources and not depend on the US. So I think we're going to see easier permitting environment compared to what it's been earlier. So the ESG, DEI, that crowd where, the hatred for fossil fuels, the hatred for mining, that's going to be replaced by, hey, we really need these metals, we really need these jobs, and we need to bring some actual real hard assets back into the country. So the mindset's going to change. And with that, financing all these new mines is going to get a lot easier. Now, we saw exactly this happen after the 2008 financial crisis. So, until 2008, where was the money going? It was going into the banking sector, it was going into all the financial products that your Goldman Sachs and Lehman Brothers, all these guys dreamed up. It was going into housing because housing was the foundation which was the base for all the financialization. But after that, what happened? Where did all the funding go? The funding went to mining, and the funding went to natural gas, and it went to shale oil, and that continued all the way until the oil price crash of 2014. So if this is a parallel to the 2000s, I think we are going to see mine permitting become a lot easier, and we are going to see mines become extremely attractive for their cash flow. Now, this is something we haven't seen in a long time, because 2009 to 11, yes, it was a commodity bull market, but the miners didn't make as much money because cost of raw materials was going up, cost of diesel was going up, everything was going up. So you had cost inflation as well as higher sales from the higher metal prices. And this time, gold has gone so far ahead of the commodity complex that you're finally going to see good free cash flow margins for new projects. And I think that's something that no one's prepared for. So, which is where I am positioning, because it's kind of a long term play. But if you think about it, it's something where you can just buy these stocks right now and sort of do nothing for a year or two. So, that's a really sweet place to be in. So I don't have to trade in and out. I can take a long view, and unlike call options which have an expiry date, the mining stocks, I'm probably going to get diluted 5-10%, but there's no expiry date. So as long as metal prices pick up, the financing cycle comes back, I'm golden there. So the other sector I'm focused on is shipping. So we have been talking about shipping since 2019, way before it became popular. And the opportunity in shipping is, so Trump, the new administration, they have massively increased sanctions on vessels transporting Russian oil. And same goes for Iranian oil. It's gotten to the point where even China and India don't want to allow sanctioned vessels into their port because they are afraid what if the US strikes back for doing that. So we have got to the situation where a big chunk of the fleet can no longer legitimately transport oil and oil distillates. So what happens to shipping rates when you take that supply of the market? It goes up. Now the counterpoint there is the Red Sea is kind of opening up because now we have the Gaza ceasefire. But even with Red Sea opening up, this dynamic plus Red Sea is kind of not exactly open because everyone talks about, yeah, it is kind of safe, but no one wants to risk it because it's been, and it's also the herd mentality. So the Red Sea was closed for shipping sometime in October 2023, and until someone actually goes and says, hey, look, it's safe, no one wants to take the risk. But who's going to be the first one to take that risk? Not any of the companies which have a public reputation to keep up. So it's kind of a chicken and egg situation, which means that rates probably continue higher for much longer. In fact, studies have come out saying the VLCC, which is the biggest crude carriers, they're going to earn rates in excess of $100,000 this year. So these were the kind of rates we saw in April 2020 when these vessels were being used for floating storage. So that was a time when oil prices went negative and you got paid to take delivery, store it on tankers, and then sell it in the future when prices went up. So we Grace have kind of gotten to a point where we could see a repeat of the margins that they earned in 2020, and no one's looking at it because shipping, I mean, there was an ETF earlier, then it got delisted, now there's a new one, but it's the kind of sector no one really looks at because it's hard to understand, it's hard to see what's happening in that space. And why bother, right? I mean, you have tech in the news, you have all these China in the news, you have Latin America, and you have all these good things in the news. Why would anyone bother with shipping? So, for someone who picks individual stocks, that's the opportunity for me, and that's where I am. So, shipping, commodities, a little bit of LNG, but lots and lots of gold explorers, which have highly economic projects now that the price is going higher. And with that portfolio, I'm kind of very comfortable. And the only place I have outside of that, luxury and casinos. So I think with China opening up, everyone's been scared of China getting into a deflationary environment, sell everything that's related to China, sell everything that's exposed to China. Like iron ore, no. Bauxite, no, because China is doomed. And what do you see happening instead? You see China coming back. And it's the same thing. So if you look at what happened in the 1990s, Japan had a deflationary bust. What did they do? They kind of did nothing for a while, and then they started printing money. 2008, US had a deflationary bust. What did they do? They right away started printing money. 2023, China has a deflationary bust. What do? They kind of try to say, no, we're not going to do what the Western world is doing. They fight it for a while. They allow bankruptcies to happen. So Evergrande, they just let the company fail. So they did a lot of things that surprised a lot of people, a lot of international investors. And then what did they do? They started printing money. So it's like no matter what, the central bankers, the governments, they're at this point where they cannot stop printing money. So when you get to that point, the rules change. So all the economic models that we are used to seeing, which we know from earlier, those don't hold true anymore because you get a crisis for a day. Silicon Valley Bank, what happened? I remember that was a Sunday morning. Janet Yellen comes out and says, "Oh no, we are never going to bail out Silicon Valley Bank." Evening, there's a bailout announced. It's that quick. 2008, when GM was about to be bailed out, there was actually a bill passed in Congress. There was a debate. People didn't want the government to bail out GM, but they did it anyway after a lot of debate. Now there is no debate. The bailout just happens. Credit Suisse, same thing. The bailout just happens. So I think, and right now, Japan has the second biggest bank in Japan, Norichukin Bank, that's almost about to go bankrupt. So it's developing in real time. Anyone who's not paying attention to Japan would have missed it, but it's happening. So let's see what they do. Maybe we'll get some news on that early on Monday, and that's probably why the yen is strengthening. So that's the other dynamic at play. And I have just been rambling for a long time, so I'm just going to hand it back to you.
No, you're good. It's I think there's just so many different ways to play this, and I think that's a thing that people forget. For me, it's like I want to. I was just talking to a buddy the other day, and by the way, if you guys have questions, I see there's 500 people in the room at the moment, so feel free to write in any questions you have. Twitter, you can ask questions, but we can't write back to you, but we will see what you write. But yeah, so people. I was just having a conversation with a buddy, and I was saying, there's many ways to play this, and I think people are going to take it. The international guys are going to be like, hell yeah, we can go buy China or whatever. Macro guys like me. And then there's the other guys who are like, hey, these sectors in the United States, like energy, gold miners, so on, we can own some of these things, and that's true as well. Um, and the commodities guys like me are going to be more excited about the commodities space. Like it's just how it goes, and there's many ways to play it. For me, the way I really think everybody should be playing it is taking a little bit from each of these sectors, which is what I do. I want to be in some of these international stocks. I also want to be in these commodities. I want to be in the gold miners. I want to be in the United States sectors that I think will do well in a weak dollar environment. And I think that's how you have to really play it. And then if you get into a micro level, like what you do, get more into the explorer space, because the gold miners are going to do well, but the explorer space, this is where you get your big 10x, 20x winners. So they could be the big winners in this cycle. Usually it doesn't start out that way, but usually at the end of the gold cycle, if we're going to see gold continue to move higher like it did in the 2000s, they're going to be the big winners. Absolutely. And so once again, it's a figure out how exactly you want to play this. I also think there's something to be said about, and you've heard me say this a million times, you never know where your biggest winners will come from. I say this all the time, and I think it sounds strange to people at points, because it's if you're a trader, you should know that this will go up or this will go down, and that's all bullshit. That's stuff that people tell you to sell a service. If you're a trader, you understand that the best you can do is follow your strategy and your plans. That's why I don't have certain people on here who trade like me. You guys always mention that in the audience a lot, like why, you bring on these different people who are different from you. Absolutely. I love it. That's the best thing about trading, because we're all different. And so figure out, what type of strategy you're going to run, how you're going to play these strategies, how many different things you can be in as a trader. Can you be in, the areas like a shop? Do you want to take advantage of it on a fundamental angle? Do you want to take advantage of it in a trend angle and just continue to buy breakouts in all of these different areas and understand, like, I don't have an idea of which one's going to win. Kashop doesn't, we both have an idea that I think Kashop, if I look at Kashop's strategy, shipping stocks will do well. The gold miners will do well. Some of these areas that he's talking about will do well, but why wouldn't he just buy all in one? Well, the reason is because he also doesn't know exactly what's going to be the biggest winner out of that. And I think that's something that we don't talk about enough as traders. Like, it doesn't sound great to sell a service when you say, I don't know which one will be the biggest winner. You can just look at all of my trades and pick one or two and pick the ones I have the most conviction in. That's garbage. That's not true. Look at anybody's trading portfolio. Look at a 13F of George Soros or Druckenmiller or any of these guys. They're diversified, even though they'll say things about being a pig and, don't be diversified, diversifications because you don't know things. Like, sure, they say these things, but then they go look at their portfolio. They're not in two trades. So I think that's kind of the important way to play this, is think about it in many different ways. There's many different aspects and ways to trade this thing. And as you continue to walk around and find these different areas that you want to be in, don't really, I think too many people are thinking too much about it. Oh, I can't buy China, that makes me a commie or something. Like, people think about it too much, and it's like, well, if it's going up and to the right and it makes sense in your financial models, however you're trading, then trade it. It's as simple as that. The commodities, same thing. I have people all the time who are like, well, I don't really understand commodities. I'm like, and these are people who are technical traders. It's like, well, if you're a technical trader, who cares? You're a technical trader. You look at the price action. That's it. So what's the difference if you're looking at, a stock called the NASDAQ, if you're looking at the Qs, or if you're looking at, a specific stock, or if you're looking at commodities, or if you're looking at a bond? Like, it's all the same thing if you're trading off a price action. So just trade the damn thing. Mainly my point, my rants to say, like, however you're trading, diversify it a little bit. Try to find these different areas and find a few names inside of it. And I'm sure if I go back to Kashop and say, how many of these gold explorers do you have? You wouldn't say you have one.
I have 20.
Yes, exactly.
Yeah.
So that's my point. You have 20 of these things. So obviously you have more than one of these things. You have 20 of these things, and that makes perfect sense. Like, none of us on here are ever gonna, like, anybody who's a professional trader, they're never gonna be like, yeah, I'm all in on this stock because I think it'll be the best thing in the world forever and ever and ever.
So here's the funny thing. So I pick, my style. So I'm a discretionary trader. I'm comfortable with fundamentals and the technicals. So my biggest position last year was a company called New Fortress Energy. I stocked it for close to a year and I got the perfect entry point. On balance, volume was starting to go up from rock bottom. Stock had a band squeeze. The short interest was crazy, and the fundamentals were great because the company had a settlement coming, which was a big chunk of their market cap. Everything looked good. I bought in at close to the perfect price, and it became my biggest position. And then one of these gold explorers, out of the blue, went straight up, and the small position, I'm up around 150% on it, and that became my number one position. Did I see it coming? No. It was just the stock went straight up, straight up, straight up, like a hockey stick, like a small cap crypto, just kept going straight up, and in no time, it became my number one position. And there was no way I could have seen it coming. You just have to place your bets and wait for luck to show its hand.
Yeah, and that's the best way to put it. It's just, you place your bets, and then you just, however it comes out, it comes out. I mean, that's the truth of trading, is like, yeah, like I just posted a thing the other day, And Kashop, you and I was sharing my portfolio this entire year, which was 2020. 2020 was a year where, I think March I had a really good return. It was about 30%. If you guys go to my channel, it's not even behind a paywall. So, if you guys just want to see the returns from 2020, go to my channel. It's just a few posts ago. I think I posted it on Tuesday. Um, but you'll see that there's basically we have a huge return in March 2020, because obviously the systems, everything started going short. The regime model went short early, so early that actually I didn't make any money until March. Then basically March happens, and then we make a ton of money. We're having a really good year, and then basically the returns, because in April everything that you were short you got bounced up against, and basically everything just V bottomed, and so they went against you. The only thing that actually held up the portfolio and made it flat in April was that oil trade. So I was still short oil. But then if you move forward throughout that entire year, basically we go through 6 months of nothing, like chop around, and then September comes, and then we're down like 15%. So we get hit 15%. So now at this point we're only up probably 20% on the entire year. October comes, we have a really good month. November comes, we have an insane month, the best month I've ever had as a fund, which is over 50%. December's very similar to November, so we end up the year over 120%. So the main point of what I'm saying is, like, thinking that year is a perfect example, and this is why I brought up that to my subscribers, is that year, if you go back to it and you look at it, it's a perfect example of I don't know shit. Like I know how to put on the trades, I know how to risk manage well, and I know how to put on my best. Take your A+ setups. Again, I hate when people grade setups, because it should always be your best setups or what you're taking. So continue to take your best setups over and over and over again, and at some point they'll all go the right direction, hopefully, and you'll make some money. So I think that's it's a good story of, like, win rates, and people thinking win rates have to be so high to do this well. And it's like, yes, it sounds really cool when you're selling a newsletter to tell people you have a 90% win rate. But really, when you're trading, it doesn't mean shit. If you're, that year was one of my lowest win rate years, and it was the second best year we ever had as a fund. So it's like that's how this works. So continue to, understand you don't know where your biggest winners will come from. You don't know when they will happen. But as long as you run your system, your strategy, and you run it well, and it has some sort of edge, you will make money at some point. I think we did get a couple questions. If you guys have questions, feel free to write in. Okay, so this is a good one. Are you trading any themes you have in your site, like water, space, aging population, that you don't discuss? I like this. Kashop, you could go
So
first.
yeah, so for water, what I do is, for me, water is something that's tied to my energy trades. So I want to know if the company has access to water, and I kind of do monitor some stocks which are sort of in that niche where they have water. But other than that, I don't think it's very tradable. I know there are ETFs for it, but that's not my forte. Space, I think it's not profitable. And even if it is, like, SpaceX is private, and I'm not going to buy Virgin Galactic. So I don't think there's anything in that space that I can actually look to buy. There are themes that I have my eye on, for instance, biotech. But the problem is it's a very binary trade. So if at all I decide to play biotech, what I would do is find someone who's extremely good at running a long short biotech fund and just give them the money, because these are the niches where you really need active management, you really need expertise. And these are the, so if you are looking to be a fund manager, if you specialize in some of these themes, you will definitely do well, because there is no one doing active in that space, and it will probably mean you do a lot of private deals on top of public deals. But something like that. Or if you set up a business development company and you do deals like that, I think that does really well. In the public space for a generalist trader, it is really really tough. So the themes I focus on are more where, so let's just take gold explorers. So there are probably 800 to 1000 of them. I need to whittle that list down to 20 to 25 in which I can invest. Now, if I take water and there are like just 10 companies, then that doesn't give me much of a choice. So I like to have my choice because I like to go deep into the company's fundamentals and do my research. So if I'm doing these niche themes, long story short, I would just find someone to take my money and, do the work.
No, I agree, and for me, it's I try to know what I'm good at and I'm not good at, and I think that's a very important thing as a trader, which is do I go through and dig in at small cap or micro cap stocks? No, I never do because I don't know anything about it. And I'm very comfortable with admitting that. You guys will bring up stock names from time to time. I won't know the ticker symbol. I'm not a stock picker, especially on the micro cap, small cap space. Sure, I know all the big names. Everybody does. That's nothing special. But I try to stick to what I know and understand well, and I feel like I understand the macro space well, and I have plenty to pay attention to there, and that's what I try to do. So but yeah, so there's another question here. Sorry about the dogs. It's part of the brand at this point. Um, oh, actually, it was just a comment. So I trade commodities the same as equities. When I get confused about what commodities are doing, I ask Jason Purse what's going on. But that goes back to what we're saying is like you trade everything the best you can, but also like understand where like your weaknesses are. And for me it's like finding those people that are like trusted in your eyes to find those areas that you need sight on. So if you need to see like gold miners, like talking like a shop about the individual names as a person, if you're talking about the gold trend or the commodities themselves, like palladium, platinum, silver, gold, like sure, my systems will tell you when they're in uptrends or downtrends, or what regime we're in or what model we're in to do so. Um, so I think it's more of a figure out the strategy that works for you. Figure out just a few people to pay attention to. Don't pay attention to too many people. I think people generally, as traders, the one thing we all have trouble with is paying attention to way too many people. We want to know what everybody's doing on Twitter, or asking the question, how are people doing trading? Like how is this person's portfolio doing? You should not care about that. It doesn't matter. And it's the same as like comparing yourself to the S&P 500. It really doesn't matter. Um, Especially if you're just learning how to trade. People like me, I have a fund. I have to explain myself to people sometimes, which I really could care less to do. But because of that, yes, I look at the S&P 500. I think about it. But if you're just an individual trader, you have no reason to be beholden to anything. It's the reason why someone like Kashop can sit in the explorer space for a long time and just go, okay, let's wait for this specific position to happen. Let's wait for the specific trade to happen, because you have that time. And I think too many people who are retail traders feel like they have to like rush trades or make money immediately or outperform the S&P every single month. And it's like, no, you just have to do what you think is going to make you money in the long run, and the system and the strategy that works for you. That's got to be the goal. And that's the truth of everything, and that's the reason why you guys have seen me on here with tons of different traders. There's not one trader who trades exactly like me, and there's not one who I trade exactly like either. um, so yeah, we can leave it at that. If you got anything you'd like to add, Kashop, feel free.
Yeah, so I have a confession here as you were just saying this. So when I was new to trading, there was a point when I was new to full-time trading, there was a point where I had S&P envy.
Mm.
So what I used to do was every week I used to look at my portfolio return and the S&P total return, and I used to drive myself nuts thinking, how can I outperform the S&P total return the next week? Now, if you understand my strategy, which is small caps, fundamentals, value, and just letting the trend find itself and run, you know how insane that is. I should not be targeting low volatility. I should not even be looking at weekly returns. Forget about weekly. I shouldn't even be looking at monthly returns. But when I started, I kind of had that feeling, oh, I have to make money every week. I know I'm not a day trader, so I didn't try to make money every day, but I wanted to make money every week. And if I'm down for the week, then I want to be down less than the S&P 500. So basically, I wanted to do something that's a low vol SPY ETF with a portfolio which is small caps. And that was a disaster, and it took me a while to unlearn that. Now when you follow a lot of people on Twitter and you look at this is their strategy, that is their strategy, it's very easy to just say I'm going to copy what Jason's doing because he's really good at it. But Jason will sit through a 30% drawdown in, I don't know, Norwegian power futures. If I say S&P, it's like, yeah, what's the big deal? So let me just say Norwegian power futures. Jason will sit through a 30% drawdown. You won't. I won't. I most definitely won't even trade those contracts. So if you actually try to mimic someone's strategy or think that's the way to do it, it doesn't work. So the takeaway from these conversations is we all have different styles, and listening to these conversations just tells you what you can kind of try to take into your own style and what you most definitely should not. So if something doesn't fit your goals, it doesn't fit your approach, then you should not take it. If something does fit, so the things I've taken away from what Jason does is I love looking at on balance volume. I love looking for relative strength. So not the RSI, but relative strength. I love looking at Bollinger Bands. So I use ATR stops. So I've taken away some things, certain things I haven't because it just doesn't suit me. For instance, I can't bring myself to buy ETFs because even if I like something and there's a great ETF on it, I would say I'm going to pick stocks and do better because that's just what motivates me.
And that's what
But
you
there are
do.
things that, yeah, that's what I do.
Mhm.
So there are things you can take away and things you can't. And knowing the difference actually cost me a few months. So I'm just passing this on so that you don't waste those few months if you're new to trading.
No, that's a good point. And thinking about it too is like, when we, for example, if you have a volatile contract, for example, Bitcoin, and we are looking at one position, and I am sitting in that position, and the trailing stop is 30%, and which it really is. Norwegian power futures aren't that volatile, but Bitcoin absolutely is. And I'm the only asshole who would know that Norwegian power futures aren't that volatile. But anyways, but Bitcoin being in a 30% volatility, meaning that my position is sized that way, that 30% is only 1% of my portfolio. And that's a thing that you have to understand about like traders and how they're doing things is like either if you're just looking at it and you're going, wow, and Jason's been sitting in that drawdown and like, and then you look at the returns, you're like, well, the biggest month drawdown he's had in, years is 15% or, something like that. So how, in the world would he hang on to something 30%? That's the reason it's all about position sizing. So understanding like the type of trader you are, this position sizing, it always has to be number one. And yes, there's different ways to do it. It doesn't always have to be exactly the way I do it. And it all depends on your time frame, which is the width of which turns into the width of the volatility of each position. So, for example, I'm a more longer term trader, hanging on to those long term Bitcoin trends, like the ones from $1,000 to 17,000 in 2017. That means you have to have a very wide trailing stop and are in it for a long period of time. If you're a shorter term trader, you could have a 15% stop if you cut your time frame in half. So like, this is why I always tell people like, when I first started trading, the biggest problem I had was I didn't understand that trading 99% of it is position sizing. And I would go and talk to, the gurus and friends of mine that were trading or people who were actually good or other traders who traded at the hedge fund that I thought did better than me. And I'd be like, hey, what's the secrets and how do you do this? And the answer came up every single time is position sizing. Read this position sizing book from Van Tharp. And I'd want to just throw it at a wall or scream at them and be like, just tell me what to buy, but that was the secret. The secret to trading is really position sizing, figuring out how to do it well. It's fun to talk speculation and, hey, we're going to buy this stock and, I think it'll go up $1 billion. But if I size that as my full entire portfolio and then that position turns against me, I'm losing everything. It's the same as if I took Bitcoin and if I took my whole portfolio and put it in Bitcoin and I didn't use a trailing stop, and then that drawdown of 30%, that's 30% of my entire portfolio at that point. Instead of now, the way it's set up is it's 1% of my whole portfolio. So, it sounds confusing at first, but once again, learn about position sizing, read those books. It is so perfect for what everybody does. Whatever type of trader you are, you have to understand position sizing. It's impossible to make money over time without understanding it. So, all right, guys, I think that's it. Thank you guys for joining us. We're here every week at 11 a.m. on Fridays. We're also on Mondays at 11 a.m. Check us out. We got, if you go to our Twitters, you could see anything we do. So I have a Substack channel. You guys subscribe. We put out all of our trade ideas. You get to see those returns, the position sizing, all of these things on there. So make sure to check that out. And Kashop, tell people where they can get a hold of you.
Sure. So I'm on Twitter. My handle is at Kashyap286. And I have my website, which is kashyapsriran.com, as in my name. So I also run a subscription based service. So you can get access to my newsletter. And I also share my entire portfolio. So everything straight from my entry point to the percentage weighting. I share everything for subscribers. So it's all there. Check out the site. It's $150 a month, still kind of doing an introductory pricing because that's how it works. So yeah, just check it out and follow both of us and ask more questions the next time around. So let's make this more interactive. And I had a blast doing this. It's been great to come back after a 2 week break. So thanks for that, Jason. Thanks for the push to get the show back on.
Of course, man. Well, thanks for joining us, and always happy to have Kashop here, and he'll be here next week, and we'll see you guys soon.